you. Good morning. Yeah, nice to see you again. I remember my last visit was in May, and it was only 3 months since my last visit, and the market has changed a lot. Okay, so we are aware of this wild swing, this volatility in the market. Today, I'm going to share with you my view on the outlook of the Chinese stock market. Is this roller coaster ride over? Is it over yet? Okay, I'll share with you my view later. This is the risk disclaimer that I need to show. Okay, although the market has stabilized a bit on starting from Thursday, I prepared my material up to Wednesday because I flew down on Thursday. So this is a recap of the performance of the China and the Hong Kong market. The Shanghai Composite Index was down 43.5% from the peak. It reached the peak of 5,178 points in around July. And then, in June, and then over the last 2 months, it has dropped more than 40% from the peak. Of course, the last 2 days, it rebounded to around 3,002 to 3,003. Yet year to date, up to Wednesday, it was still down 9.5%. So that was the performance of the Shanghai Composite Index so far. Okay. As for the Hang Seng Index, it was down less from the peak. Down 26.3% from the peak, but year to date up to Wednesday it was down 10.7%. So there's a discrepancy, in the performance between the China, the Shanghai Composite Index, and the Hang Seng Index. I think it can be explained in such a way that because you have a sharp rally in the Shanghai market starting from the beginning of this year. It really shows rapidly. So the correction from the peak was more hefty. You have a very big correction, for more than 40% correction from the peak. Whereas the Hong Kong market, it lags behind. It's more rational. It did not rally as much as the China market in the first half. So the correction from the peak was less. Yet recently, because I think there is concern about the economic outlook of China, so there is capital outflow from both China and Hong Kong. Because Hong Kong is more liquid market, foreign capital can easily go in and out of, move in and out of the Hong Kong market. So the recent correction on the Hong Kong market is, you can see that it's more, is weaker in terms of performance compared to the Chinese market. And the Chinese market, there's always this invisible hand trying to support the market. The last 2 days rally is some conspiracy theory goes that is related to the military parade next on the 3rd of September to celebrate the 70th anniversary of the victory against the Japanese occupation. So they are trying to support the stock market before the military parade. So that's one thing to take note of. If that's the case, that means after the military parade, be careful that the invisible hand will disappear. Okay. As for the Hang Seng China Enterprise Index, which is comprised of the H shares, it was down 37% from the peak. It tracks the Shanghai Composite Index more because the components are Chinese companies, H shares of Chinese companies. So it was down in terms of compared with the Hang Seng Index, it was down more from the peak. And year to date, it was down 21.3%. So performance was quite bad on the Hong Kong market recently. Okay. Now let's look at the chart, this Shanghai Composite Index. You notice two sell-off. The first sell-off, the Hang Seng Index, the Shanghai Composite Index dropped from 5,178 points to around 3,400. It dropped from about 5,000 to below 3,500. And then there was a rebound because of all the supportive measures implemented by China. They tried to ask stockbrokers to buy shares, and then they forbid shareholders to sell. For those shareholders holding more than 5% of listed companies, they are not allowed to sell. This is China. Okay, so it resulted in a rebound to around 4,200 points, to around 4,200 points. And then there was a second sell-off. Then the Shanghai Composite Index dropped below 3,000. The sell-off brought it down to below 3,000. To me, I think the causes of the two sell-off are quite fundamentally different. The first sell-off is more due to the market situation. Then it was too speculative, too much over speculation, and then over leverage. You heard reports about the margin financing in China, which ballooned from around 1 trillion yuan to more than 22 trillion yuan, more than double the margin book, the lending. And then actually the real lending, amount of lending is more than that, because you may have heard reports about unofficial or the so-called illegal fund matching companies. They are, those companies are mushrooming in China before the crash. They lend money to individuals, to retail investors, to speculate in the stock market. And then the lending, the leverage is even bigger than the margin lending provided by stockbrokers. Stockbrokers are, because they are regulated, they are allowed to lend up to 2 times of your deposit of your invested capital. But for those fund matching companies, 配资公司, they can lend up to 8 times to 10 times of your capital. So some of the investors, they deposit 10% and then they get 90% financing from those fund matching companies. Those are all illegal. It's very difficult to crack down those companies. But ultimately, after the sell-off, the leverage has come down. Officially, the outstanding margin financing dropped to now currently, I think, is about 1.3 trillion, 1.3 trillion from more than 2 trillion yuan. So the market is deleveraged. Then what caused the second sell-off? To me, I think the second sell-off is different from the first sell-off. The second sell-off is caused by disappointment or concern about the economic outlook of China after the recent release of a batch of disappointing economic data. Personally, I've been upbeat about China and Hong Kong. If you have attended my presentation in the past, I had always been upbeat about China and Hong Kong because the valuation before the rally, it was cheap. And then the growth was still intact. So I think China has been undervalued and Hong Kong has been undervalued. But this time round, I had to admit that I am less upbeat about China and Hong Kong. I think China is getting more problems concerning its economy, and it has tried many measures such as interest rate cuts, now they cut it again, but it seems that this is the 5th time they cut the interest rate, and also the 3-4 times they cut the the reserve requirement ratio. Yet the previous cut did not have any significant impact on the economy. So that shows that China now, they tried many things, but those things have not worked yet. So the next 3 to 6 months will be quite crucial. I will share with you the investment strategy. If with that kind of backdrop, with that kind of concern and reservation about the economic outlook, what kind of strategy we should adopt going forward. Okay, let's look at the some of the economic data released. For the first half, so far so good. China GDP grew by 7% in the first half, and originally people are expecting another 7% growth in the second half. So full year, the official target of 7% will be met. But now I think looking at the current rate that things are going on, and also the latest economic data, I'm doubtful that the economic growth can reach 7% in the second half. So personally, I'm projecting 6.8% to 6.9% at best economic growth in the second half. Okay. GDP, as you may be aware, are made up of three major components. That is fixed asset investment, exports, and consumption, domestic consumer spending. In the US, consumption makes up for two-thirds of the GDP. But in China, fixed asset investment accounts for more than two-thirds of the GDP. So when fixed asset investment slows down, it also drags the economic growth. In July, China fixed asset investment slowed down to 11.2%. In the first 7 months of the year, from the year earlier period, missing estimates for 11.5% gain. I think if you look at all the economic data in July, they came in much lower than the market expectation. So it is this disappointment that trigger. Also, just now, my colleague has mentioned devaluation. I'll talk more about that. Why did China choose to devalue the yuan at this point of time? It's, I think, can be easily seen. It's because the economic data are very disappointing. They have to do something to stimulate the economy. Okay. For property investment, fixed asset investment only expanded 11.2% in the first 7 months, and real estate investment, which directly accounts for 15% of China's GDP, grew 4.3% in the first 7 months, the slowest rate since the first quarter of 2009. So actually, China has done quite a lot to stimulate the economy. But because fixed asset investment accounts for two-thirds of the GDP, and then property investment, real estate investment, accounts for another, again, two-thirds of fixed asset investment. So when property investment slows down, the Chinese government can do very little to stimulate because this is from the private sector. Property investment is mainly driven by the private sector. Admittedly, there are signs of improvement in sales. Total floor sales rose 6.1%, up from 3.9% increase in the first half. So after the rate cut, and to be fair, the sales have improved a little bit because of the rate cut and also the RRR cut. Average new home prices also rose marginally, 0.3% in July from June. Month on month, there is a slight increase. But year on year, the July home prices, average new home prices, was still down 3.7% from a year early. Okay. So one worrying sign is that new construction reflects the confidence of the property developers, and also on the coming investment in property hinges on new construction, new home start. New construction fell 16.8% in July, in the first 7 months, worsening from 15.8% in the first half. Why? I mean, on the one hand, I show you that home sales have improved. Why new construction still continued falling? It's because of this huge overhang of unsold home, which deters developers from starting new construction and also buying land from provincial government. If you look at the revenue from land sales, that's another indicator of the confidence of property developer. Revenue from land sales in the first 7 months plunged 954 billion yuan from a year earlier. This is a very, another impact on China is because a lot of the provincial government, they relies on land sales to back up their finance. So with shrinking land sales, the financial strength of many provincial governments come into question. Earlier before they have this swap of debt, provincial debt, to help them meet the repayment of provincial debts. I think yesterday there was a new move by the Chinese government. You may read in the reports. Now they loosen the restriction on foreign capital to invest, in the property market from two aspects. First, for buyers. Now they have banned foreigners living and working in China less than 1 year to purchase to buy their property, their own property. Now they relax it. So for foreigners who are living and working in China, even less than a year, they are allowed to buy property. Okay, so that's from the buyer side. From the developer side, they also relaxed the rule on foreign property developer. In the past, the registered capital, share capital of those developers have to be at least 50% of the projects. They invest in a project, say if it's more than 10 million US dollar. So their registered capital have to be, they have to have registered capital at least 5 million US dollars. Now they lower it to 40%. So a move to encourage more foreign developer to participate in the China property market. I think the motive is quite clear. They want, because now the domestic market is shrinking. Domestic developers, they are quite hesitant in terms of buying new land and starting new construction, because they are cash strapped. They are not confident about the demand because they can see these unsold homes. It's reported that it takes more than 10 months for all the housing inventory to be taken up, to be digested. So now they try to look outside China to get foreign capital to invest in the real estate market. But I'm doubtful of that, because foreign investors are not stupid. At a time of a slowing property market, and also with such a huge overhang of unsold homes, who will jump on the bandwagon? Am I right? And then foreign ownership of property accounts for a very, very small percentage. Take Shanghai, for example, which is a very cosmopolitan city. It's reported that foreign ownership, property ownership, only accounts for 0.5% of property. China is so big, so foreign ownership actually accounts for a very small proportion of the property transaction. I don't think it will help a lot in stimulating property investment as fixed asset investment. Okay, so that is fixed asset investment. I mentioned three components make up the GDP. Second component, exports. So China exports very bad in July, down 8.3%. It was expected to be down only 1%. So the actual figure was much worse than expected. Import also down 8.1%. It was hurt by lower demand, external demand, and also the strong yuan. 8.1% down decline in imports. And then the third component, retail sales. Total retail sales of consumer goods was up only 10.5%. The pace was the slowest pace in also 2-3 years. Okay. And industrial value added production, this is industrial output, added 6%. On the face, it looks quite good, up 6%, but the projection is 6.6%. So again, this is 10%, nearly 10% lower than the expected figure, the projection. Okay. Those are historical data up to July. So we always look at leading indicator, barometer of how the economy will fare in the next 3 to 6 months. So we look at these purchasing manager index, which are seen to be leading indicator of the economy. This is the official manufacturing PMI, which is released by the Chinese government. It shows it's more compared to the one released by market. There are two sets of manufacturing PMI, the official one and the market one. The market one was sponsored by HSBC. HSBC used to sponsor that, but now they no longer sponsor the market PMI. So they get another sponsor. It's called Caixin. Caixin manufacturing PMI. Wow, it shows you a totally different picture compared with the official one. The official one still holds about around 50. It's not dropped below 50. So for the PMI, 50 is the threshold between expansion and contraction. When the index stays about 50, that means the manufacturing sector is expanding. When it drops below 50, means contracting. Okay, so the official PMI shows the manufacturing sector is still expanding, though at a very, very slow pace. But if you look at the Caixin manufacturing PMI, it dropped to 47.1. And also 4 months is the 4 consecutive months below 50. That shows the what does it show? Okay, the preliminary Caixin China PMI in August. That's the August preliminary figure. And also why is the two PMI so different? Because this Caixin China PMI, it tends to focus on smaller and medium-sized companies, whereas the official PMI focus on state-owned enterprises. So the response of purchasing managers are quite different. State-owned enterprise purchasing managers tend to be more confident because they have the backing from the state. But for these smaller and medium-sized companies, they don't have the state support. So when the economy slows down further, they will feel the pinch more. Okay, so this index dropped to a near 6.5-year low of 47.1 in August, and again much lower than the forecast of 47.7. And if you look at the sub-indexes, it's more worrying. Both the new orders and new export orders, sub-indexes declined at a faster rate than in July, a sign of accelerating weakness in domestic and external demand. So if you look at the PMI, one can tell or forecast that exports will not improve. July exports was already quite bad. I showed you the chart just now, down 8.3%. So will there be any significant improvement in exports in the next month? If you look at the PMI, the answer seems to be no. So the Chinese government has to do something. As for China, I think the threat comes from two sides. First, economic slowdown. How much? I mean, at what rate the economy slows down? That's one threat to China. The other threat is deflationary risk, because both CPI and PPI, the Consumer Price Index and the Producer Price Index, were so soft in the last. CPI has dropped below 1 for China, below 1. But recently has managed to bounce back to 1.6 in July, more because of pricier pork. Pork prices, I think you have heard about reports of pork prices rising starting from April this year. Because pork prices have its own cycle. China, I've explained, unlike the US and other developed countries, China's hog farming industry is very fragmented. A lot of individual farmers, hog farmers. So when they don't have any long-term plans regarding their farming plans. So during the market peak, before the market peak, a lot of people, because pork prices rise so much before the peaking of pork prices, that induce many individual farmers to increase their farming, and then that caused an oversupply. And subsequently, when the price dropped to a certain stage recently in April, finally pork prices have bottomed out because many farmers are forced to exit. They lost money on their the business, so they have to exit. And now with shrinking supply, now pork prices we can forecast that it's on an upcycle. So there's a 3-year cycle. 1.5 year will be on the rise, and 1.5 year will be declining. So now it has bottomed out in April this year. We expect pulp prices to be on the rise in the next April, in the next 18 months. We expect pulp prices to peak out around September next year. But that will support the CPI a bit. But PPI, you look at PPI, producer prices fell to the lowest level since 2009, was down 5.4%. It was the 40th month, 40 months in a row. Negative growth in PPI. This one is because of two things. First, because China's demand for all the commodities, iron ore, coal, except for oil and petroleum, because China now is building up its strategic reserves of oil and petroleum. So China is importing quite a lot of oil and from outside. But other commodities such as iron ore, coal, the prices of commodity drop because of weakening demand from China. Okay, and that caused the PPI to drop further. So China is actually facing a hard choice, whether to let the value of the yuan fall, that is to depreciate the yuan to help exports and risk capital outflow, or to maintain the value of the yuan and watch exports continue to fall. I think that's the alarm bell for China, the July export figures, which was down 8.3%, and that triggered the devaluation in the last 2 weeks. So I think the answer, you already got the answer for this question, that China has chosen to devalue the yuan. But what China has underestimated is the timing. I think the move is right because you can't, we have analyzed there are 3 components to the GDP. Fixed asset investment, China now can do very little. They have approved trillions of, in terms of value of infrastructure projects. They have already approved railway infrastructure projects. Yet the fixed asset investment is very much dragged by the property investment. And I have explained in that aspect, China can do very little because that involves the private sector. Okay, so consumption, consumer spending, we don't see any new initiatives from China, such as the kind of 家电下乡 subsidies. In the previous round of stimulus, they provided subsidies to consumers to buy home appliances and cars, but now they stopped that. So it seems that the only area that they can stimulate is export by devaluing the yuan. But just now I mentioned the timing. It seems that they got it wrong. The move is right, but the timing is wrong, because this is the time when the foreign investors are getting agitated or getting nervous, edgy about China's economic outlook after the release of the disappointing economic data. And then you devalue the yuan. Of course, it means now there are signs that the house is on fire, and you open up the door. That means you encourage people to rush out. Am I right? So that caused the sharp devaluation, which I think is not desired by, not intended by the Chinese government. So they quickly came out to say it's not their objective to devalue a long-term devaluation of the yuan, trying to calm the market and stabilize the fund outflow. Then China make another move. They cut interest rate and also the commercial bank's reserve requirement ratio after the recent change to the yuan's fixing mechanism. To me, I think this is an effort trying to kill 2 birds with 1 stone. First, I give you the information about the rate cut. Both deposit and lending rates were lower by 25 basis points, taking the 1-year benchmark deposit rates to 1.75% and the lending rates to 4.6% after the rate cut. And then the commercial banks' reserve requirement ratio were reduced by 50 basis points to 18% of their deposits. So that means for every $100 deposit they take from the depositors, now they can lend out $82. In the past, when the reserve requirement ratio was as high as 20.5%, they have to keep 20.5 yuan as reserve that they cannot lend out. So by reducing the RRR, on the one hand, commercial banks get more deposits to lend out to those who want to borrow money from the banks. But more importantly, I think yes? Oh, I think it can go back down to 15% because compared to international standards, 18% is still very, very high. 15% can be seen as the norm for China. So both, if you look at the deposit rates and the lending rates, how low, you may ask the question, two questions. How low can rates go down? And how low can this RRR be reduced? For the rates, you look at the real interest rate. We have to look at the real interest rate. That's the interest rate minus the inflation, the CPI. So China in July, the CPI is 1.6%, am I right? And the deposit rates now, they reduce it to 1.75%. So the real interest rate is about 0.15%. When real interest rate become negative, it's more difficult for the central bank to lower interest rates. So this is one thing that we have to take note. I mean, to answer your question, I also give my thoughts on how low can interest rate be reduced. I think it's very near because if pork prices continue to climb, I personally do expect this CPI to continue to rise to 1.8% or even to 2%. 1.8% is quite possible. And with 1.8% CPI and deposit rates at 1.7%, then the real interest rate becomes negative. So it would be quite more difficult for the central bank to lower interest rate when real interest rate become negative. Okay. As for the RRR, I think there's more room, still more room for the PBOC to lower the RRR. Okay. I explained why it can kill two birds with one stone. Now it's related to the devaluation. Now, after the devaluation, because the yuan, the PBOC wants to support the yuan now. It has underestimated the response from the foreign exchange market that the selling pressure on the yuan was so great. So they have to sell large amounts of foreign exchange to prevent the yuan from depreciating too much. They have to buy yuan from the foreign exchange market, and they have to sell foreign exchange. So over the last 2 days, you heard reports about China selling US Treasury. So that will also have an impact on the yield of the US Treasury. Yield will go up because of more supply of US Treasury from China. That will also cause an impact on the US Treasury prices and US Treasury yields. And back to this move by the PBOC, if they continue selling foreign exchange to buy yuan, it will result in draining liquidity from the banking system, tightening monetary conditions. So that explains why China did, I will explain later, some open market operation in the bank, in the open market to increase liquidity. A 50 basis point cut in the reserve requirement ratio is expected to pump 6,000 billion yuan into the banking system. So I think this RRR cut, if you ask me, if there's only one reason for the cut, I would say it's more related to the depreciation of the yuan and not to stimulate the economy. Because if they try 3-4 times already with the RRR reserve cut, that doesn't seem to work. Why they chose to lower the RRR at this point of time? It's more because they hope to stabilize the yuan by pumping liquidity to the banking system. But second effect from this RR cut would be, it will allow banks to lend out more to borrowers, and hopefully it will stimulate lending and the economy. But I would like to add here, whether it's effective is actually hinges on the banks. Whether the banks, now they are allowed to lend out more, but whether they are willing to lend out more and who they select to lend out more is another question. Am I right? So banks, if you look at the first half results, the NPL, the non-performing loans and the non-performing ratios have been climbing very quickly. So I think banks are at the moment very risk averse. They want to control credit risk. So despite lowering the RRR, which allow them to lend out more, they will still be very selective and also very discreet when it comes to lending. Okay. And I mentioned just now, you look at the series of moves taken by the PBOC in the last 1 week. They also inject liquidity into the banking system through its open market operations, which include reverse repos. Repos and reverse repos are operation taken by PBOC to either take out liquidity from the market or inject liquidity. Reverse repo is an agreement with commercial banks. Commercial banks will pledge their, will sell, in a sense, pledge, actually sell their bonds they hold to the central bank to get a financing from the central bank. But under the agreement, normally this is a 7-day, very short-term repo arrangement. After 7 days, the banks have to buy back. That's why it's known as repo, repurchase, to buy back the bonds they pledged to the central bank. And then they have to, the liquidity will be taken out from the banking system. So this is how this reverse repo function. So in the last 2 weeks, they have done two very big, huge reverse repos. In the first week, the amount involved reached 120 billion yuan. And this week, another reverse repo with the amount totaling 150 billion yuan. So they try to inject liquidity into the banking system. And also, in addition to reverse repos, they also use this SLF, standing lending facility. This is also a kind of temporary lending to the banks, commercial banks, by the central bank to lend them money, to lend them funds, so that it will increase liquidity in the banking system. SLF normally the time span is 7 days. Is a 1 week operation. As for medium-term lending facility, normally it lasts 30 days. So they use a balance of SLF and MLF to inject liquidity. Okay, just now there's a question from the audience whether how low we can go. So we do expect more easing measures in the latter half of the year. There will be at least one more rate RRR cut, 50 basis points before the end of the year, and one more rate cut, 25 basis point before first quarter of 2016. But this rate cut depends on the CPI. I would like to add, if CPI climbs very rapidly in the next few months, say for instance, if it climbs to 2 or above 2, then it will be a bit difficult for the PBOC to further reduce interest rates, because the real interest rate become negative. Okay. So to sum up, personally, I think in the next 3 to 6 months, the economic outlook is quite uncertain for China. Whether all the latest stimulus measures will work remain to be seen. But you just keep an eye on the monthly data release. If there's an improvement, then in terms of investing in China and Hong Kong, you can take a more aggressive strategy, a more aggressive stance. And if there's no improvement in the monthly economic data, then I would advise caution. Don't rush. But in terms of valuation, valuations is starting to look attractive again. So the risk return now seems more favorable. I remember showing this chart every time when I present about Hong Kong and China. This is the valuation, the PE band of the Shanghai Composite Index. So this is the mean, the fair value of the Shanghai Composite Index, which is around 4,000 points. I remember in May when in my last presentation in Singapore, I mentioned that now Shanghai, the China market, has finally risen to above fair value. It has been below fair value for so many years, for such a long period of time. So it's undervalued. It has been undervalued for maybe it's caused by skepticism about the economic outlook. Then early this year, the rally brought the index above the fair value. But every time above fair value, that means we are entering dangerous territory, dangerous regions, when the market starts to get pricey. And what is meant by pricey? When the PE rises towards this +1, this is +1 standard deviation from the mean. Last time, you see, in 2009, after the 4 trillion yuan stimulus, the Shanghai Composite Index rebounded really sharply to around 3,400 points. And then it almost hit the green line, the +1 standard deviation. And together with the austerity measures taken in 2010, then there was a collapse in the valuation and also a collapse in the stock market. I think China, last round, after the QE taken by the US, they joined force with the QE. They launched this 4 trillion yuan stimulus. But one side effect is they caused the inflation, runaway inflation. Let me show you the CPI again. You get a clearer picture of what happened. Now, before the subprime crisis, the inflation in China also, it was already overheating. It went up to 8% CPI, 8%, horrible. But also, for emerging markets, high inflation became the norm at that time. So after the subprime crisis, the global financial crisis, CPI became negative. And then they launched this 4 trillion stimulus package, and then CPI soared again to 6%. And then they found it was suddenly they realized that they had done something wrong. They want to cool down the overheating economy and the inflation, so they introduced austerity measures. The property market, there was the time they imposed a lot of restriction on the property market. Remember, not allowing Chinese individuals to buy more than one property, and also restriction on foreign investors to buy property in China. So the austerity, after the austerity measures, CPIs have came down quite substantially to 2%. Now is even below 2%. So what I want to point out is, because of the stimulus package, they have to do remedial measures to remedy, because it caused overheating in the economy and also high inflation. Then they introduced the austerity measures. And because of the austerity measures, the stock market suffered from that. Everything came to they control on bank lending, they control on the property market. So the stock market was in a slump for more than 3 years. Only until July, the second half last year, it started a rally. But again, the rally came too fast. The rally came too fast, so it became irrationally very expensive. Then it caused the first collapse. So the first collapse actually brought the index to the fair value. It's healthy. It's a healthy correction. The first sell-off, it was, to me, I think it was a healthy correction because now the valuation becomes fair value again. But the second sell-off, now it shows pessimism because now it's trading below fair value, and again the valuation is close to -1 standard deviation. -1 standard deviation means it's very undervalued. So this shows now market is dominated by pessimism. It's more pessimistic, so you get unusually low valuation. I think in the short term, the market will be kept, even if there's a rally, it will be kept at 4,000, the fair value. And then it will move between 3,000 and 4,000 or lower 2,500. Okay, for Hong Kong and China, actually, you see here, the valuation of the Hang Seng Index, it's dropped. Even it's back to the 2012 and 2013 level, 2012 and 2013 level. Okay, so in terms of valuation, the Hang Seng Index is actually quite cheap at the moment. Now, the mean, the fair value is 29,800. Now it's trading at 21,600. Yesterday it dropped again after briefly rising above 22,000. I think it shows that yesterday, China, the Shanghai Composite Index continued to rise. But Hong Kong, after there's a intraday reversal, it closed down more than 200 points. I think China is because it's propped up by, I mentioned just now, conspiracy theory goes that they want to prop up the stock market before the military parade. But Hong Kong, there's no, I mean, the invisible hand does not stretch its reach to Hong Kong. And Hong Kong is a more open market. When foreign investors are not confident, they are doubtful, then they just exit, they just sell, okay? The CEI, the Hang Seng China Enterprise Index, now also back to 2013 and the 2013 and 2014 kind of low level of valuation. So my advice for the moment is, if you have holding power and also patience, you can buy, but you have to be still very selective. Try to avoid the cyclical stocks, those stocks that are vulnerable to economic cycles, because many stocks, many sectors in China, I mean, become victims of oversupply, overcapacity. So avoid those sectors. Say, for instance, iron, steel, coal, cement. These sectors are still suffering from overcapacity and over supply. And then select banks. No, I also don't like banks. I will explain a little bit. Yesterday, actually, the decline in the Hong Kong market was dragged down by banks. BOC have released its first half result. Earnings up only 1.1%. So now the earnings growth has stalled. I think next year we may be witnessing negative earnings growth. So when you buy companies, you are looking for companies with growth. Banks will not give you growth now, I'm quite sure, Chinese banks. And Chinese banks, they are very dependent on interest income. 80% of their profit and revenue comes from interest income. In the past, Chinese banks, it's very easy for them to make money because interest margins so wide, and also there was tremendous demand for loans, for lending. Now interest margin has shrunken from above 3% to around 1.6%. That's more towards the international standard. But I do expect more downward pressure on interest margin. China is undergoing this process of interest rate liberalization. You remember during the recent interest rate cut and the RRR cut, they announced also one, people tends to neglect that one thing, for deposit, fixed deposit more than 1 year. For fixed deposit, they have removed the cap on the deposit rates. That means banks are allowed to offer whatever saving deposit rates for fixed deposit longer than 1 year. That means banks in the past it's capped. Big banks, small banks, the deposit rates you can offer to your client are all capped at the same level. So with no difference in interest rates, what the depositors will tend to choose the bigger ones, because the bigger banks will tend to be safer. Am I right? But now people will have a choice. If smaller banks can offer higher deposit rates, they can grab market share from the big banks. So this is unfavorable to the big banks. And then in May this year, China has started the insurance scheme for deposits. So deposit insurance scheme means a certain amount, up to a certain amount. I think I don't remember clearly whether it's 100,000 or 200,000 yuan will be insured. Even the banks go under, you will be compensated your deposit. So this will also help the smaller banks by leveling the playing field. So for the big state-owned banks, I think now they face, and also on top of that, the NPL, the asset quality is deteriorating quite rapidly. Just take CITIC Bank as an example. I analyzed the first half results. It made about 23 billion yuan net profit, but it has written off impairment of losses from bad debts from loans amount to more than 10 billion yuan. So one third of the profit they write off. But because now they still have big earnings, I mean fat earnings, so they can write off. Just imagine when the earnings growth stall and they have still to write off. So the NPL ratios at the moment actually is not as low as it is, because I'm not saying that they falsify the figure. No, they hadn't. But because of the impairment, they just write off the debt. So NPL can maintain a relatively low NPL ratio. But if in future they are unable to write off huge amount of bad debts, then the NPL ratios will surge very rapidly. I come of a simile of the investment in Chinese banks. The simile is like investing in a very old building. The condition inside is actually deteriorating day by day. Am I right? But the yield is good because the old building, the selling price is low. Now banking stocks, they are selling below, many have already dropped below the NAV. They are selling below NAV. And then the yield is around 4 to 5%. So it's just like buying old building. In Hong Kong, many people, I'm not sure whether it's the same case in Singapore. In Hong Kong, a lot of old buildings. They buy the old buildings, they 劏房 你知道吗？劏房 they cut it into many small rooms, cubicles, and lend out. And then the gross yield is actually very attractive. Can be up to 8%, 10% yield. But the capability of capital appreciation of the house, of the property is getting lower and lower because it's a simile. I compare banks with investing in banks with buying old buildings. Now you still get the yield, but one day when old buildings become the structure becomes dangerous for living, 危楼的时候, then the worth and also the yield, nobody wants to live, you can't lend it out, they will not be able to pay the kind of dividend and yield by becoming 危楼 means when the asset quality deterioration comes to a very, of course it will take time. I don't expect this to come in not even in next year, but maybe a few years down the road, this problem will become more acute for Chinese banks. On the one hand, earnings growth stall. On the other hand, asset quality continues to deteriorate. That's why sometimes the market is, I always feel that the market is smart. Why Chinese banks are trading below NAV? It's because it reflects investors' reservation, skepticism about their future, their prospect. Okay, so I just give you two examples of the companies we have invested. Those are companies that may be spared of the economic downturn. So what I suggest is avoid the cyclical stocks, buy stocks that are resilient, that are less cyclical, that will not be vulnerable to economic cycles. This is one company that we have invested in for our client. It's called Pax Global. The stock code is 0327. It's a leading Asian electronic funds transfer, e-payment terminal, point of sale solution provider. So it provides the design and development of e-payment terminal, the POS machine, but it's not involved in the manufacturing. One good thing about this company is it does not do the manufacturing. It outsources all the manufacturing to factories in China. So it competes on technology and also on its safety standard. It develops and sells countertop and mobile e-payments terminal, which are able to process a wide range of electronic payment types, including signature and PIN-based debit cards, credit cards, contactless and radio frequency identification cards, RF-enabled mobile phones, IC cards, prepaid gift, and other store value cards. I think there's this tendency in the world that cash transaction is decreasing. More transaction. I think, is it Australia? Which country? I read they or in Northern Europe, they don't allow cash transaction anymore. All transaction will be in either credit card. So that I mean the trend is to eliminate on cash transaction. So it will benefit this company, which is engaged in the manufacturing and also the provision of e-payment terminal. Today, it has sold over 9 million e-payment terminals in more than 80 countries and regions, and is recognized as one of the 3 major international mainstream brands, ranked number 3 globally in terms of shipping volume of e-payment terminals in 2014. Well, I'm not recommending you. They're saying that you must buy this stock. You may not share with my view. I'm not recommending, but it's an example to show that how we choose stocks. First of all, choose company to invest is we like companies that have the industry that has a high entry barrier. That means not anybody can join the industry and compete with you. So this one, because it has to have the rectification from all the payment institutions such as Visa, MasterCard, Union Pay, they have got the rectification from those institutions before their e-payment terminals can be accepted, because it will a lot of falsify or fraudulence to avoid. So the entry barrier is high, and then they compete on technology, innovation, and not on pricing. Okay. The share price, I think we bought at around $4 or $5, and then it went up to $14. So because of the business performance, recently after there was a deep correction, and I think it's an opportunity to accumulate around $7. I show you the financials of the company. Okay, this is the last 3-4 years financial figures. So its revenue increased from around 1.1 billion Hong Kong dollars to 2.3 billion Hong Kong dollars in 3-4 years time. So it has double, revenue double. And then net profit increased from 181 million to 391 million in 2014. So the revenue double, yet the net revenue more than double. More than double. It's up 120%, around 120% from 2011. Okay. If you look at the financial highlights of first half result, why was it sell off? Because I think the market was a bit disappointed by the top line growth. Its turnover increased only 10%, 10.1% in the first half. So that came below market expectation. So that caused the sell off. But if you look at other financial figures, I think it's still worth a buy. First of all, sales volume of the e-payment terminal was close to 1.5 million units in the first half, and turnover from overseas markets increased by 22.7% to 555 million Hong Kong dollars, accounting for 50.1% of total turnover. So now this company is not it's not just operating in China. Its revenue, half of the revenue is derived from overseas. So it's an international a company with international competitiveness, and there's a healthy mix of revenue in terms of geographical presence. Net profit attributable to shareholders increased by 55.9%. There's no exceptional gains because of improvement in gross profit margin. So the net profit attributable to shareholders increased by 55.9% to 309 million. Remember last year how much it made? Net profit 390 million. And this year, just the first half, they made 309 million. So full year, save the same. I mean, if they manage to make the same kind of profit in the second half, full year, they will make 600 million. 600 million, that is almost double the 390 million last year. So despite the rather slow growth in turnover in the first half, net profit still grow very rapidly in the first half. Gross profit margin rose 3.7 percentage points to 41.5%, mainly due to an increase of contribution from overseas sales and successful cost reduction. I think this is also quite impressive because a lot of company, it's a Hong Kong-based company, it's not Chinese company. A lot of company, when they sell to the overseas market, they have to compete on pricing. So the gross profit margin of companies, a lot of companies' overseas sales tends to be lower because they have to compete on price. But this one, you can see that they can even command higher profit margin, gross profit margin from overseas sales. That means their products, they can are up to international standards, and they can enjoy a high gross profit margin. And net profit margin increased to 27.9% from 19.7%. That means for every $100 business they do, they make $27.9 profit out of the $100 sales. Okay. Outlook. What's the outlook of a company? When we invest a company, we look at a few things. Now, whether there's growth, and then what is the outlook? It may be good. It might be performing well in the past. It doesn't mean that it will continue to perform well in future. So we have to analyze the outlook, the prospect of the company. It has a few growth drivers going forward. Overseas emerging markets, there's huge growth potentials in the Asia-Pacific region, namely Brazil and Middle East, and also Asia-Pacific. A lot of those countries will go on a installation spree of the e-payment terminals in those emerging markets. Even for, this is a typo error here, sorry, overseas developed markets, these developed markets, the US is undergoing EMV migration, which requires the adoption of chip and PIN or NFC in replacement of the magnetic swipe and sign system in the past, because they feel that the security standard is not secure enough. So now they want to change all the credit cards and debit cards using the EMV technology. So the migration will create demand for new e-payment terminals, and that will benefit global PAX Global, because US is also one of the major markets apart from Europe in the developed markets. As for China, the number of installed e-payment terminals in China is only 12 for every 1,000 persons. So the penetration rate of e-payment terminals in China is still very low compared to 23 to 24 e-payment terminals installed for every 1,000 persons in the developed market. So there's still room to grow in China. And the PBOC has issued guidelines to encourage financial institutions to promote non-cash payments in rural areas. They want also that that's the international trend to cut down on cash transaction, to encourage more transaction by using bank cards. So this will be a positive for the company. The PBOC and China Union Pay are currently promoting the electronic terminal network with NFC. More than 700 million chip cards with quick pass function have been issued by China Union Pay globally, stimulating the demand for e-payment terminals with NFC function in each market. So this would be the growth area, the growth driver for the company. Okay, another company, an example of those we have invested is gas operator, China Gas. The stock code is 0384. It is a gas operator and service provider. It is engaged in the investment, construction, and operation of city gas pipeline, infrastructure facilities, gas terminals, storage and transportation facilities, and gas logistics systems. It's also engaged in transmission of natural gas and LPG to residential, industrial, and commercial customers. And it has expanded its business into car refueling stations, refueling CNG, that stands for compressed natural gas, or LNG, liquefied natural gas. So this company is, I want to make it clear, is a downstream operator. It is not involved in the mining, in the upstream exploration and mining of gas. That's more risky. It's not involved in the upstream. Actually, it gets supply of natural gas from the upstream companies like PetroChina, Sinopec are its suppliers. So it just buy the natural gas from those oil and gas company, and then they sell to their customers. So they can always pass on whether if there's a rise in gas prices or cut in reduction in gas prices, they can pass on to their end clients. They all earn the margin of providing gas provision to the client. Okay. As of end of March this year, the group has secured a total 273 pipe gas projects with exclusive concession rights. So in terms of number of pipe gas projects, it's the largest in China. 273 gas projects. And what I mentioned just now, we prefer companies that have, or industry that have a high entry barrier, that not anyone can come and compete with you. So the pipe gas of business is actually very exclusive. They have to secure concession rights from the provincial government. And once they get the concession rights, it's exclusive. Every city, they only allow one operator. So once you get the concession rights, no one can compete with you. And the concession rights normally last for 25 to 30 years. So you can be quite sure of the future earnings in the next 25 to 30 years. Of course, there are there's always risk in all kinds of investment. What I said seems to be riskless. No, don't get me wrong. The risk will lie in consumption of natural gas. If there's other, the consumption of natural gas comes down, it will affect means lower revenue for the company. And it also depends on the conversion of vehicle, of how many cars in China convert from using gasoline and diesel to using LPG and LNG and CNG. The more cars using, that means more consumption of natural gas. And then another uncertainty or risk factor would be the price of natural gas and supply of natural gas. When there's a shortage in supply of natural gas, it will affect the business because they rely on the supply from the oil and gas company. But I think you heard about new report on China and Russia signing long-term gas supply, natural gas supply. They are going to build pipe, long-distance pipe, gas pipe from Russia to China. So that would guarantee, ensure there will be sufficient supply of natural gas in the next 20 to 30 years, because it's the policy. I like, because it's the policy of China to encourage using natural gas to replace gasoline and petroleum. Okay, so it also owns 13 long-distance natural gas pipeline projects, 520 CNG, LNG refilling stations for vehicles. So it's sizable. It has 520 refilling stations, and the company is one of the shareholders. Is Sinopec, Zhongshihua. So Zhongshihua actually owns more than 30,000. It's the largest number of gas refilling station, gas station, not gas. 那个是油站 also called gas station. Zhongshihua owns more than 30,000 gas stations in China, more than PetroChina. And then now they have cooperation with Sinopec, and also it's partly owned by Sinopec. And then they have agreement that allows the company, China Gas, to select, to pick from the gas station owned and operate by Sinopec, to convert it or to install natural gas refilling facilities in the gas station. So in terms of site, they want to expand their gas filling stations, but one bottleneck would be the site, whether you have the suitable site. And now actually in China, all the prime areas are already taken up. If you want to find a very convenient site for building a new gas filling station in the heart of the city, I think it's quite very difficult. But with the cooperation with Sinopec, they have this advantage of sites, a lot of choice for them. Okay, they although I said they are not involved in the upstream business, they do have one coal bed methane development projects. Coal bed methane is 煤层气, so they can extract natural gas from coal. Normally, natural gas is not extracted from coal mines. Those are called 非常规天然气. It's not the normal kind of natural gas. So they have one experimental project, upstream business, mining natural gas from coal mines. This is actually an experimental project. And then they also are involved in the LPG business. LPG stands for liquefied petroleum gas. I think in Hong Kong and China, in Singapore, in the 70s, 80s, a lot of people were using the 一罐罐的那个can of LPG. Now I think still, of course, fewer people use that because a lot of the property, the houses are connected to pipe gas. Am I right? But in China, remember, half of the population still lives in rural area. Rural area, they don't have the gas, the pipe gas supply yet. So they have a lot of consumption using LPG. Bottles of LPG they have to deliver to your home. You remember those days? So it had 98 LPG distribution projects in 25 provinces, municipalities, and autonomous regions in China. But the LPG business, the sales is quite huge. But the profit margin is low. Profit margin is about 4 to 5%. But the sales, the turnover is very quick. The profit margin is not very good, but the revenue is quite sizable. As at end of March, the total connectable urban population covered by the group's gas projects has increased to 91.84 million households. That means all the 273 projects, we calculate how many total connectable population under all his projects. So it has increased to 91.84 million households. Each household normally have 3 to 4 members. So that means actually its total connectable population has exceeded 100 million. And then I will also wish to point out that total connectable, that means not all are connected yet. The penetration rate supplied by the company is around 40%. So 40% of the project, the households under is covered by its projects are using the company's natural gas. That means another 60% are not using it. So if these households are not connected and not using, ultimately they are connected and they start using natural gas, that means that will be the future growth area for the company. They has not reached saturation. The penetration is only 40%. There's still room for growth in terms of sales, natural gas sales. It has 3,600 industrial customers and 71,000 commercial customers. In China, natural gas, the price of natural gas for the downstream operators, if they want to raise the price, natural gas, for residential customers, they have to conduct testimony. They call 听证会, to seek the consent from the residents. So it's a bit difficult for them to raise gas prices for the residential customers. But residential customers only account for 20% of their total income. The rest come from industrial and commercial customers, because industrial customers use a lot of natural gas for their manufacturing. Residential customers use actually very little. You cook, you boil water for your bath and shower. That consumes not as much as natural gas compared to the industrial and commercial customers. And for the industrial and commercial customers, they negotiate. They don't need to conduct the kind of 听证会. They just negotiate with the customers the price, and because they have this concession right in the city, in the area, so they have a strong pricing power. Unless the customers say, oh, it's too high for me, I cannot afford, I want to convert it back to using other source of energy, but it would be quite costly for them. So they have strong pricing power over industrial and commercial customers. And of all also please take note, of all 273 city pipe gas projects owned by the group, 190 projects were in the operation phase. That means there are 63 projects still under development, under construction, not contributing any revenue yet. Just imagine if these 63 projects start contributing revenue, that will be the future growth driver for the company. Okay. Share price actually outperformed the market. I show you the chart, the Hang Seng Index and the sse-a Index actually dropped back to the 2012, 2013 level. Am I right? But 2012, 2013, its share price was below $4. Now, despite the correction from $16 to $11, it's still more than double the 2012, 2013 low. So for companies that can manage to grow 20, 30 or 30, continue to grow rapidly, I see no reason why the share price should not reflect. So I always emphasize, focus on the grow the company with good growth prospect and also the ability to continue to grow. Okay, you look at the financials, very impressive. Its financial year ends in March. So in 2012, the revenue came in at 18.9 billion yuan. This is renminbi. And then ending March this year, its revenue had increased to 31.6 billion. 31.6 billion, almost double from 2012 in 3 years' time. The net income in 2012, it made 953 million yuan. This year, last year, 2015, it made 3.3 billion yuan. So net profit has not double, as nearly double. But profit, how many times? You calculate from 950 million growing to 3.3 billion. Okay. It sold a total of 8.97 billion cubic meters of natural gas during financial year 2014 and 2015, representing an increase of 11.6% over the same period last year. Okay, so it also shows that its business, its revenue grew faster than the economy. And remember, the economy last year, China's GDP grew 7.5%. And its sales increased by 11.6%. So we favor company with growth rate higher than the broad economy. That's also one criteria we look at when we pick stocks. And if a company that can that only post sales growth or profit earnings growth less than the GDP growth, why choose those companies? That means they underperform the broad economy. Okay. LPG, they sold 2.41 million tons of LPG, representing an increase of 37.4%. And revenue increased 21.8%. Sales-wise, increased 11.6% and 37.4% in terms of volume. But in terms of value, dollar value, monetary value, revenue increased 21.8% to 31.6 billion. In financial year 2015, net profit increased even more, 29.9% to 2.97 billion. What's the outlook? According to the action plan on prevention and control of air pollution promulgated by the State Council, China will accelerate coal to gas projects across the country. In the next 3 to 5 years, the coal to gas market will see rapid growth. This is called 煤代气, replacing oil by gas. So they encourage more consumption of气代煤, replacing gas, replacing coal by gas. So in the next 3 to 5 years, actually in some very polluted areas in China, Beijing, Tianjin, Hebei, they don't allow any increase in coal consumption, and they have already published official target. They have to cut down coal consumption to a certain amount in the next 3 to 5 years. But to replace, you cut down coal consumption, you have to find replacement, am I right? Natural gas is the replacement. So this will favor, that means more consumption of natural gas. The group continues to implement its, ITS, Hub Satellite Cities Development Strategy by securing more piped natural gas projects in industrialized cities, economic development zones, and industrial parks. These new projects will be the group's major future growth driver. I explain a little bit because they have secured the concession right of the city. And then because of the urban development in China, many industrial factories, they are ordered to move their factories outside to the outskirts or suburbs of a city because of pollution and also urban development. So these become those become potential customers for the company because they can expand their concession rights. Just apply for approval from the provincial government. They can supply gas to those industrial and commercial customers in the outskirts, in the suburb of the cities they are operating. So that will expand their business territory to cover more customers. Okay. And the group aims to build 1,000 natural gas refilling stations for vehicles by 2017. Just now I mentioned they have 520. So they plan to build another 480 in the next 2 years up to 2017. Is it possible whether they can achieve the target? The answer should be yes, because I mentioned they have the collaboration with Sinopec. Sinopec will provide the sites for them to build these natural gas refilling stations. And regarding gas refilling business for vessels, for ships, China is also encouraging vessels to use more natural gas instead of diesel or fuel or gasoline. The group also owns the patents and intellectual property rights in LNG vessel engine modifications. Because for vessels to be able to use natural gas, they have to modify their engine. And the company already owns the patents and intellectual property rights for LNG vessel engine modifications and advanced oil to gas conversion technology for vessels. It has drafted a 3-year strategic plan for the development of its vessel gas refilling projects. But admittedly, the plan details for the vessel gas refueling projects is still quite scarce if you look at the financial reports, because it's just started. It's at the commencement preliminary stage. We'll watch out whether there are more details. At the moment, it's just started, this vessel gas project. Okay, so that ends my presentation.